Fundstrat's Tom Lee. Happy New Year. Welcome back.
Happy New Year, Scott.
Are you wavering at all by virtue of what's going on this week?
We're not wavering, but it's clearly not a good start to the year. I mean, markets almost got to an all-time high at the end of last year, and the first four trading days of this year have been really terrible. I can see what the market's struggling with because, as your guest previously talked about, part of it is when the Fed cuts, and I think people are still jumpy about a strong labor market and if inflation is softening. But our base case still remains that, we're going to see all-time highs in January. And then I think the market is tough in the first half of this year because of some of those things. But we'll overall end up strong by the end of the year.
But you're not rethinking your own outlook at all by, how... I mean, you obviously sound somewhat concerned by the way this year has started. Maybe it didn't go according to your plan. So how's that all factoring into your psyche?
Well, yeah, I mean, I think it is disappointing because, the year tends to play out in January. So the fact that we're, sort of had a failed Santa Claus rally in the first 5 days is pretty important, and the market looks like it's going to be negative, just tells you that the fundamentals, which have been improving, aren't necessarily going to convince investors to be buying stock. So I do think it's telling us it's going to be a tough year. But the reason we're not wavering is that the reasons we think 2024 will be a good year for stocks has to do with the fact that the PMIs are bottoming and inflation's falling like a rock, and the Fed has pivoted and is now managing a business cycle. I mean, those are really good anchors and supports for why stocks can do well, but it's not a great start. I mean, it might be much better if we were up for the week.
Yeah, well, I mean, bulls would feel better. What about this ISM services report? I mean, I know you talk about PMIs, but is that concerning to you?
Well, it's there's pluses and minuses. I mean, to me, I think the ISM services employment number and the manufacturing number show you that the labor report we got today may not be as strong as it looks, and I think that's actually good because we don't want a labor market showing signs of rejuvenation. I think the trend there is sort of softer employment growth. And from a prices perspective, I think it's pretty supportive of what we've been seeing, which is, prices are falling. And as long as housing and cars don't surge, housing growing at 3% is fine. That's consistent with 2% inflation. I think inflation is going to eventually be viewed as, approaching target, and that's actually good. So, Scott, the data isn't always in a straight line. I think it's a little messy this week, and I think it is disappointing to see. But I think too many are going to be quickly turning bearish and then put on their hard landing or skeptic hat or the Fed hawk hat, and I think that's going to prove to be a mistake.
So you look for about 10% out of the S&P, but more or less is what you think we're going to do from here. How many cuts do you need to get that?
Well, it's not as dependent on cuts as it's dependent on really inflation approaching, what we'd all accept as close enough to 2% so that the Fed is no longer fighting inflation. So it's not going to be as important as cuts as really sort of the quality of the inflation data. And I think the second is that, we do need to have a rebound in earnings and global growth, which I do think is underway. And, as inflation is normalizing outside the U.S. And when you have that combination of inflation sort of normalizing and real growth recovery, I mean, that's good for stocks. So it's not dependent on the number of cuts.
Well, I don't know. I could almost make the argument that it's one and the same. I mean, if you get the number of cuts that the market has seemingly priced in, it means that inflation has continued to move down rapidly towards target. And if you don't, it likely means that inflation has gotten a little bit more sticky than the bulls had wanted it to be. So it impacts the ability and the wherewithal of the Fed to actually start cutting rates and doing it nearly as many times as the market still expects.
Yeah, I hear you. I think the problem people have is when they talk about cuts, they're assigning singular drivers for it. I heard someone say, well, if they make a lot of cuts, it's because the economy's in trouble. That's not the case. The Fed could be cutting rapidly because they've concluded that inflation is actually approaching normalization, and a nominal Fed funds at 5 3/8 or almost 5.5% of the upper end is not appropriate when you're at 2% inflation. I mean, that's 3% real Fed funds. At the same time, the Fed may not have to cut. The market could actually conclude this by seeing interest rates fall. So we could be in a situation this year where the 10-year is at 3.2%, and FOMC members may be wavering, but the stock market will rally because it knows the Fed is behind the curve and needs to cut. So I guess this is the reason why I'm saying the cuts aren't as important as really the quality of the inflation improvement. And maybe it's more important to see what rates actually do.
Before I let you go, I want to ask you about Apple. I know you're still bullish on mega caps, but you don't expect them to outperform to the magnitude that they did in 2023. This stock has obviously not looked good this week. It's down more than 6%, variety of reasons. And we listed them earlier: downgrades, chatter about antitrust, et cetera. If the stock goes through a period of upset, as I asked our prior two guests, I want to ask you the same question. What happens to stocks?
Well, it's, FANG, the destiny of S&P really does hang on FANG because it's such a large weight. I don't think FANGs are sell this year because, they actually derated over the last 2 years. Their earnings outperformed the stock price performance. But you are getting periods like this where, people get nervous. It's one reason why I do think the story in 2024 is going to be a lot more about small caps and sort of some of the laggard groups. Financials is our number one large cap sector pick. But I mean, if I owned Apple, I wouldn't be a seller here. Their franchise and sort of returns on investment are still enviable. So, if it's down 6% but was up 44% last year, I think people have to kind of look through that.
All right. We'll leave it there. Tom, I appreciate your time very much. We'll see you soon.
Thanks.
All right, Tom, that's Tom Lee, Fundstrat. Up next, trading bio.